We dividend investors love a good discount, and in this video we're going to cover 3 stocks that are exactly that and have seen negative share price returns in the last month and so far year to date, making them potentially great buys as we head into the month of May. But before we get to those, in case you're new to the channel, my name is Ryan Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you love dividend stocks and if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. Also, leave me a comment below and let me know which dividend stocks you have your eye on. I'd be curious to hear what you think is looking good. Anyway, getting into the first stock of the day, this one is WP Carey, which is one of the largest net lease REITs with a portfolio of nearly 1,500 commercial properties leased out across about 400 different tenants. Now, one of the things that I really like about WP Carey is that they're pretty well diversified, both geographically and in terms of the type of real estate assets that make up their portfolio. As we can see, 63% of their properties are here in the United States and 34% of them are over in Europe, so they have a fair amount of international exposure. And as far as the types of properties they own, 26% are industrial, 24% are warehouses, 17% are offices, 16% is used for retail, and then the remaining 15% is for self-storage and other miscellaneous uses. And now, taking a look at their share price performance in the last month, things are not looking too hot for WP Carey. They are down 7.3%, which brings them to a year-to-date loss of about 6.6%. And then if we zoom out across the last year, they are down a whopping 14.4%. And admittedly, even though we're seeing some really nice drops in share price for WP Carey, the valuation metrics, namely the P to FFO, is still looking about average. We can see here the forward P to FFO is 14.18, which is still about 15.33% above the sector median P to FFO of 12.3. Now, in its own right, this double-digit P to FFO really isn't too terrible. I mean, we definitely have seen lower in the real estate sector. But speaking personally, I'm choosing to take advantage of the drop in share price, and I am buying the dip on WP Carey. I started adding a little bit more to this position as of late. This tranche here is from last week, and so far I've only added 3 more shares to my WP Carey position. And taking a look at my full position here on my dividend portfolio tracking spreadsheet, which you can start using for free. There is a link to it in the description of this video. I hope you check it out. But with this recent purchase of 3 shares, this brings me to just over 20 shares of WP Carey, and it's really not too far above my average cost per share, which is why I decided to start adding to it again. Looking at my share price return with this company, I'm only up about 5%, and when I added this recent tranche, I was only up about 4%, so it's come up a little bit since I last added. But if we throw dividends into the mix, looking at it on a total return basis, I'm up 16.63% with WP Carey, so it's doing pretty well for me. And I will say, even though the P to FFO we looked at just a moment ago was kinda so-so, this dip in share price has still done wonders for the dividend yield, and it's pushed it up to a point where it's right below 6%. More specifically, the forward yield is 5.84%, so you're getting a really nice cash flow return from buying into this company. But with that, there is a trade-off, and the 5-year growth rate really isn't anything too crazy, just above 1%. And this says that they've been growing the dividend for the last 9 straight years, but I don't think this is quite accurate. Taking a look at their dividend history chart, their dividend payments go all the way back to 1998, so they've been paying consistently for the last 25 years at least. And in that time, it looks like they've grown the dividend pretty much every single year since then. So I would say that WP Carey is actually pretty close to being a dividend aristocrat if it's not already there. But anyway, guys, moving on to the next stock, this one has seen a really aggressive share price drop. We're talking about the Charles Schwab Corporation, and as you can see here, just in the last 30 days, they are down nearly 9%, which brings them to a year-to-date loss of a whopping 34.34%. So that's pretty crazy. And this probably isn't very surprising, as I'm sure you can imagine, pretty much every company in the financial sector saw their share price take a hit after the recent banking crisis, and Charles Schwab is clearly no exception. With that though, they just recently reported some pretty solid quarterly earnings where they beat on earnings per share and technically did miss on revenue, but not by much at all, and even so, they still saw a near 10% gain in revenue year over year. A lot of which, I would imagine, came from us SCHD investors just dumping all of our money into the fund, helping them collect more of that 0.06% expense ratio. But anyway, this company's huge drop in share prices really helped the dividend yield. It's not really high in its own right, only 1.86%, but this is still over 40% above the 5-year average yield of 1.33%, so that's nice. And the rest of the dividend stats are looking really good as well. Their payout ratio is super low, about 22%, and their 5-year growth rate's a little bit below that, 21.22%. This is very high. I love to see this, especially when you have a yield this low. You really need a high 5-year growth rate, and Charles Schwab is definitely delivering that. And although they only have 1 year of consistent dividend growth under their belt, it looks like they paused the growth here between 2020 and 2021, which I think they get a pass for. Otherwise, they've grown this dividend very aggressively, and they've taken it from 6 cents per share back in 2016 to where it's at now, 25 cents per share. So that's really nice growth. I do like to see that. And now, guys, this brings us to the third stock of the day. Believe it or not, we are talking about at&t. Now, just in the last week, at&t saw a drop over 8%, which is very hefty, and we can see that they really fell off the cliff right here, which we'll talk more about in just a moment. But in the last month, overall, their loss really isn't too bad. They're only down 1.88%, and then year to date, they are down 2.77%. So once again, really nothing too crazy. But going back to that really steep drop, the cause of this was some news that came out of their recent quarterly earnings report. On a high level for the quarter, they beat on earnings per share, but slightly missed on revenue expectations while still seeing year-over-year top-line growth of about 1.5%. The kicker here, though, is that at&t dramatically underdelivered on their free cash flow expectations for the quarter. Now, they were expected to generate about $3 billion, but instead only brought in about $1 billion, which is what sent the share price plummeting. And to add insult to injury, they paid out just over $2 billion in dividends for the quarter, which means that they didn't generate enough free cash flow to cover the dividend, which is not ideal. And having said that, they're still sticking to their free cash flow guidance of $16 billion for the full year and are expecting to see about $6 billion in cost savings, which should help them meet that guidance. So we'll just have to stay tuned for the remaining quarterly earnings to see how this all plays out. But in the meantime, I gotta say the valuation stats for this company are looking very top notch. Overall, Seeking Alpha is giving them a valuation grade of an A-, which is pretty hard to beat, and the forward PE ratio is looking really nice and low here in the single digits, 7.5, which is about 14% below the 5-year average PE ratio. And scrolling down, taking a look at the rest of the valuation metrics, at&t is trading pretty close to their book value. Their forward price to book is 1.2, which is actually right in line with their 5-year average price to book. And the forward price to cash flow, guys, this is one of the lowest I've ever seen, 3.38, which is 26% below the 5-year average price to cash flow. Very nice. Now, like WP Carey, I also have at&t in my portfolio, and I have just about 101.5 shares at an average cost that's a bit above where I'd like it to be, $21.60. So I'm taking a little bit of a loss with at&t right now. More specifically, I'm down 15.65% in terms of share price, but if we throw dividends into the mix on a total return basis, I'm only down 3.3%, which isn't anything too bad. And this is still outperforming my Verizon position by far, where I'm down about 21%. And one thing I've thought about actually a little bit more recently is tax loss harvesting my Verizon position, selling out of it, and then using those funds to redeploy into other positions in my portfolio, possibly throwing a little bit more into at&t actually. As time goes on, I just don't see much of a point in holding on to both of these companies, especially considering they are both very similar in nature. And I feel this is an area where I can consolidate in my portfolio, and it would just give me one less capital intensive business to keep track of. But I will say one advantage that Verizon does have over at&t is the dividend stats. They have a higher yield, they have more years of consecutive dividend growth, but at&t's dividend yield is still pretty solid. You really can't complain about a 6.1% forward yield, and I don't really fault them too much for these numbers right here, a negative growth rate and 0 years of growth, because I know both of these came as a result of the Warner Brothers spinoff. And with that aside, otherwise, we can see here that at&t has a really solid track record of slowly but surely growing this dividend, and there really wasn't a cut for a long time until they spun off Warner Brothers right here in 2022. But anyway, guys, those were the 3 stocks that I really wanted to talk more in depth about, and I think make for pretty decent buys as we head into the month of May. But there are still so many other great stocks that I think you need to keep your eye on. The first of which, of course, you guys know I had to mention this one, KRC, who's really actually breaking even in the last month, only down 0.3%, but still year to date they are down 21.3%. So still seeing a pretty big drop, and definitely at an attractive valuation. Really low single digit forward P to FFO right here. Next up is 3M, and they certainly have their risks right now, but still it's definitely one to watch out for. They are a dividend king, and in the last month they're only down 0.76%, but year to date they are still down 14.7%. So still seeing a pretty big loss there. And then we got to look at Johnson & Johnson, who has rebounded pretty well in the last month. They're up about 6.5%, but still year to date they are seeing an 8.7% drop, which might be a good time to pick up this dividend king. And I know we just talked about this one a moment ago, but you got to keep your eye on Verizon. They are down 0.5% in the last 30 days, not too bad. And then year to date they are down another 7%, but they are still looking pretty cheap right now. The PE ratio is sitting here just under 8, nice and low in the single digits. Another company to keep your eye on is Lincoln National Corporation, LNC, who is down 6.26% in the last 30 days. And then year to date, they are seeing a really big drop, down 32%. And I know this one could be up for debate right now, but keep your eye on Medical Properties Trust, okay? In the last month, they are up 5%. So they've rebounded a little bit in the last 30 days, but year to date, they are still down 28%. So if you're bullish on this company, now is still a pretty good time to buy it at a discount, I think, especially when we consider this P to FFO very low, 5.23. free. But anyway, next up is Tyson Foods, who has rebounded a bit in the last month. They're up 4%, and then year to date, they are down about the same amount, down 4%. But then in the last year, zooming out, they are still seeing quite a big drop where they're down 37.6%. And also, guys, you got to keep your eye on Hormel Foods. They're up 3.2% in the last month, but year to date, they are down about 13%. And in the last year, they are down 27.33%. Also, guys, the dividend stock in this next video right over here is another one you'll definitely want to keep your eye on. This stock has a near 3% yield and a super sweet 15% dividend growth CAGR. And from the looks of it, they are currently trading around a 30% discount, which is super steep. You gotta love that. So click right over here to learn all about it, and I'll see you in the next one.